everyone, welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. In this video, we're going to examine the federal funds rate and review the Fed's latest meeting. The federal funds rate is the overnight interest rate banks charge each other for borrowing. Set by the Federal Reserve's FOMC, it's a core tool for monetary policy and has a major influence on economic activity. When this rate shifts, it directly affects borrowing costs for consumers and businesses and ripples through financial markets, impacting everything from bond yields to stock performance. The FOMC concluded its seventh meeting of the year with a widely anticipated 25 basis point cut to the federal funds rate, bringing it to a range of 3.75 to 4%. This marked the second consecutive rate cut and puts the central bank's range at its lowest level since December 2022. But this decision was fundamentally different than previous ones. The Fed, the institution most reliant on economic data, was forced to act amid a massive information blackout. The ongoing government shutdown meant policymakers were somewhat flying blind, relying on intuition and incomplete private data, rather than the comprehensive statistics that usually guide every move. Now, with all of that said, this move was still highly expected, but there are still several important takeaways from the press release. The Fed continued to emphasize their dual mandate of maximum employment and low inflation, with a target rate of 2%, which we have attempted to visualize in this chart. Note that unemployment figures are only through August, as the government shutdown has delayed the September jobs report. With regards to the labor market, the Fed stated in the press release that job gains have slowed this year, and that the unemployment rate has edged up, though remained low through August. They added that recent indicators are consistent with these developments, and therefore they now judge that downside risks to employment have recently risen. With regards to inflation, the Fed continued to describe it as somewhat elevated, and again commented that it has moved up since earlier in the year. Additionally, the Fed reiterated that uncertainty about the economic outlook remains elevated. It's easy to see in this chart how the Fed's comments are ringing true. The unemployment rate remains low, but has been trending higher for most of the year, with the latest rate near a 4-year high. And inflation has proven sticky over the past 2 years, never quite reaching that 2% target level, with the most recent figures for both CPI and PCE heating up to their highest levels in over a year. So what's next? The committee stated they're prepared to adjust their stance as appropriate if risks emerge, and will continue to take into account a wide range of information, such as readings on labor market conditions, inflation pressures and expectations, and financial and international developments. Given this guidance, how is the market interpreting the Fed's next moves? The CME FedWatch tool estimates the probability of future interest rate moves. It's updated in real time in response to economic data releases, Fed statements, and market movements. This chart shows the tool shortly after the Fed's last meeting. At the time, markets were expecting another 25 basis point cut at the December meeting later on this year, and an additional 2 in 2026. Note, however, that since this tool is updated in real time, expectations are constantly shifting. Now, this latest meeting was not one in which the FOMC released their dot plot, which reveals individual members' projections of the federal funds rate. However, I've included it here as a quick reference because it's an important tool providing insight into what individual committee members are thinking. The latest dot plot from the September meeting showed the Fed projecting 2 25 basis point cuts in 2025, one of which just took place, 1 25 basis point cut in 2026, and another reduction in 2027. But the dots clearly show that there are mixed views within the committee. However, just like the CME FedWatch tool, these projections are not set in stone and will likely shift over time. The Fed's next meeting is scheduled for December 9th and 10th, where the next dot plot will also be released. That's all for our discussion. Thank you for tuning in. For economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.